I'm Charlotte McLeod with the Investing News Network, and here today with me is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Thank you for joining me online once again. It's great to see you.
You bet. Always happy to be with you.
Yeah, so we last spoke back in April. A lot has happened since then. We're going to try to get through developments in the oil market. To start, I thought we could go over some recent news. We are speaking on September 2nd, and today we got the news that G7 nations want to cap Russia's income from oil sales. Meanwhile, we have Russia saying that it doesn't want to sell to countries that impose caps. So I wondered if we could take a look at that, have you break down that situation and what it means for the global oil market.
You bet. There's no shortage of things to talk about, as you referenced, and the amount of cross currents and noise that energy investors have to deal with is almost historic. So in terms of the news that came out today, the G7 wanting to put on a price cap, it's kind of stupid, quite frankly, and I don't think it's going to achieve anything. Like it's politicians trying to make it look like they're trying to do something when really there's not a heck of a lot that they can do. Russia has been very successfully infiltrated themselves into the European power mix. There is no short-term substitutions whatsoever, certainly for their gas. For oil, they're going to try. And so what did the G7 say? They said, well, we don't want your stuff anyways. We're not going to be importing it. We've got an embargo coming in December 5th, I believe. But yeah, we're going to put a price cap on something that we're not going to use. Oh, but those people that do actually use it, they're not willing. So China, India, Turkey, et cetera, like the main purchasers of Russian oil, they're saying, yeah, thanks, but no thanks. So to me, this is just a typical, political gesture trying to show the populace that I'm sorry, we're doing our best, but there's no solution to this. It's really trying to rectify a profound mistake that was made many years ago.
Okay, so you've hit on a good point. Like you said, there is so much noise going on. Any advice for investors on how they can break through that when there are so many things coming every day?
Yeah, it's a really good question because there's everything, and there's the volatility in oil these days is epic. We've just had oil fall $10, and so you search for a headline. Like I wake up in the morning, oil's down $4. I wake up very early. I'm searching Twitter and Bloomberg, et cetera, and there's like nothing. So the amount of liquidity in the oil contract right now is very, very low. The amount of financial people that are involved in trading is very low. So the volatility is being accentuated, which means that you can have daily moves now, which you cannot justify fundamentally. And the reason why fundamentals are important to follow is they do eventually matter. Like there's two markets for oil. There's the financial market for oil and the physical market. Well, the physical market's the biggest commodity in the world. It was at one point bigger than all of the commodities combined on a daily trade basis. And so even as big as the physical market is, the financial market's 30 times bigger. So you can't have these days where, the gestures from Iran, or there's some unnamed Department of Energy spokesperson saying, the feedback from Iran isn't good, Russia, price caps, et cetera. What I follow are inventories. And that's why, like on Twitter, I tend to put up graphs that we generate using data from Kepler, the IEA, the US Department of Energy, et cetera, because inventories are my BS detector. They're the nexus of supply and demand. And if inventories are falling, it tells me that the market is undersupplied. And then you compare it to historical levels to say, okay, well, what's the quantum of undersupply? So that's really what I focus on. You're going to be whipsawed around, and you're going to be have fear and panic kick in invariably. And you'll talk yourself out of what I still think is a generational opportunity in energy stocks.
Right. So let's talk about those buckets of supply, because I remember all the way back at the beginning of the year, you gave us 3 to look at, and they were US shale, OPEC, and the rest of the world. I particularly wanted to check in with you on what's going on with OPEC, because you mentioned it was getting close to using up its spare capacity, which if that happened, it would be very bullish. So where are we standing?
Yeah, so the core of my multi-year bull market thesis, which I think very much remains intact, irregardless of, let's say, an Iranian deal struck, and then we have to deal with, okay, does Saudi, cut production, or OPEC cut production to offset, and all these different things. So why am I bullish on oil? I think you and I will be using oil for the rest of our lifetimes. Demand is going to grow for at least the next 10 years, but the real story remains On supply, and as you referenced, there's only three things to follow. There's US shale, which was like the party pooper of the past decade. There is OPEC, spare capacity exhaustion, yes or no. And then the global super majors, which is the easiest thing because we know spending by them peaked in 2014. It's fallen by half, even though oil's generally speaking back to where it was. They're under ESG pressures, divestment, decarbonization, et cetera. They're not spending. So you specifically pointed to OPEC, and the real debate is OPEC spare capacity exhaustion. For a long time, I was one of the lone voices saying, well, look at, like, if we adjust for the tomfoolery going back years ago when they had these quota systems and they jack up production, and, you know, Saudi and Russia get into I'm trying to think of a polite word, but like a X match to see, you know, who can beat the other one down and exert their will. You look at, you know, Saudi drawing storage from storage, counting that as production, saying, look, at 12.5 million barrels per day is actually our real capacity. Most people think that their real sustainable levels without incurring formation damage is about 10.7 to 11 million barrels per day. That's generally speaking where they're at today. And so for a long time, we thought, okay, well, we're just math. And as they're bringing on back supply into their quota system, by the end of 2022, they'll reach exhaustion. What was for me a massive pivot and a real watershed event was meeting with the former Secretary General of OPEC at a conference in New York. And at lunchtime, open room, he was very candid, and I got to have dinner with him later that night. He was super candid. He has since passed on unexpectedly since then. And he said, this is like a grave danger that the world must face. And he said, we're running out of capacity, as has Saudi Arabia as well. They're trying to increase investment by US shale, by the super majors, et cetera. But because of guys like me, they can't, because investors are saying, look, we've incurred absolute misery for 10 years. It's our time to get paid. So when we look at OPEC, they're I think, approaching spare capacity exhaustion. Saudi Aramco is increasing capacity by 1 million barrels per day. It's going to take them 5 years. So that's not coming on until 2027. And so that's why, like, cycle time really matters. If it takes Saudi Aramco, the most sophisticated oil company on the planet, 5 years to add 1 million barrels per day, well, over 5 years, demand is going to grow by about 5 million barrels per day. They're going to handle one of those. Where's the other 4 coming from? And so when we look at US shale, which is that other bucket, we strongly believe that we are in a post-US shale hypergrowth world. What does that mean? For so much of the past decade, US shale was growing because the stock market was rewarding it, CEO compensation plans were rewarding it, et cetera. And US shale at a point was growing faster than global demand growth. That was a serious issue, and it led to a lot of the problems and challenges and share price implosions that we've since witnessed. Today, there is not an energy investor on this planet that wants these guys to grow. What they want is the vast majority of free cash flow to be returned to them in the form of buybacks or dividends. And so the ability of shale companies to repeat the growth rates of the past would mean they'd have to take away the dividends, which they're now paying, which investors are slowly getting used to, and say, oh, I know you like that 10% per year, but we want to go use that money to go drill, exhaust our inventory even faster, which is going to be a major challenge in the next couple of years. The exhaustion of core good quality inventory, increase our decline rate, and just, you know, basically piss off all of our investors. And so we don't think that's going to happen. Like, we were just in Aspen at a really great intimate conference that was hosted by Raymond James. It was some of the biggest shale companies, also service companies. Service availability is a major factor. Labor is a major factor as well. And so we're bullish on oil, not really because of demand, even though we think demand will grow, but because US shale growth is capped at about 600,000 to 700,000 barrels per day. We have data as of May, no growth for the first 5 months of the year. So kind of supporting what we're saying. OPEC, we think they're out of capacity. Maybe they've got 1 million barrels per day, but if they're not willing to bring it on, unless there's some massive geopolitical event, it's kind of the same thing anyways. And then the global super majors can't grow. So it's this mismatch between supply growth and demand growth that makes us excited. And so when we see pullbacks like the past 3-4 days with oil down $10 on headlines about, you know, a regional lockdown in China or Iran negotiations, to me, it's just, it gives you the ability to add dollar cost average and add a little bit more exposure on down days.
Okay, I think that's a really good overview of what's going on the supply side. I want to ask you to look a little bit more closely at demand. You mentioned that you expect it to grow. How does that fit in with all the concerns we're hearing about recession, not just on a country level, but also at the global level?
For sure. So it's a very, very valid point. And I would say for investors, it's their biggest concern now. We look at the price of power at a time was up 20 times in Europe versus the trailing 10-year average. Like that's a serious issue. On Twitter, you see, people putting up their power bills and it's up like 8,000%. This poor little bakery used to spend, $8,000 a year. Now they're spending 60, and they're like, okay, like we got to shut her down. This morning, headlines about like aluminum plants, ammonia plants, I think too, shutting down, et cetera. So without question, there is an impact and there will be an erosion in demand growth. I still think we're in a scenario where even with a harsh recession in Europe, who we can debate the longevity of that, a likely slowdown in the US, you also should at some point in 2023 have China emerging from their self-enforced lockdown. And so I've seen some estimates, their demand's down about 1 million to 1.5 million barrels per day. That will offset a lot of weakness from recessionary pressures in Europe and the United States. And at the same time, there's fuel switching. So because gas was a few days ago trading at $500 per barrel equivalent, you're now seeing switching from gas to oil. And so some estimates have been that demand increases there could be as much as 700,000 barrels per day. And so, it's a very relevant worry to say, look at like the global economy because of these different issues, rising inflation, rising US dollar, power pricing, power crisis in Europe. Demand growth is probably going to be less than it normally would have been. But with the benefit of fuel switching and China at some point emerging from, self-imposed lockdown, I don't think the demand erosion is a reason to be terrified about my thesis going out the window.
Okay, and if we tie these things together, I know there's a lot of factors that we haven't discussed, but if we tie the supply and demand together, what are we looking at for a price trajectory for oil as we head toward the end of 2022? Yeah. I know it's quite difficult to say.
Yeah,
what are your thoughts?
So we have so many cross currents right now. So we've got a US president that is using every tool available to try to talk the oil price, therefore the gasoline price down going into the midterm. So we've had the biggest release from the Strategic Petroleum Reserve in history, even though Russian exports and production haven't really been impacted. And so that's been muddying the water, so to speak, to not allow people to see how profoundly tight the market is. We've had China under lockdown for much of this year, so suppressing demand there. We have Iran, we were supposed to get news today. Now there was some talk that maybe it's going to be pushed till after the midterms because there's more Democrats that are no longer in favor for it. So you've got a lot of these binary kind of situations to make oil, vacillate. I get really excited for the end of the year. Maybe September. September is usually a challenging month, irrespective of, for the broader markets. So maybe we've got another month of chop. But I think once we get past the midterms, the pressure from the Biden administration to continually be assaulting oil will be no more. SPR releases get wound down it should be the end of October. And then you've got a December 5th, you've got the Europe, which I'm told is going full steam ahead in terms of the embargo on Russian oil. You've got a seasonal uptick in demand. Q4 is the strongest period of the year for global oil demand. So I think we should finish off pretty strong. I think the Jeff Currys of the world are still calling for 120-ish Brent by end of the year. I kind of go with 100. And we're all kind of doing this, but the market remains very tight. Fundamentals remain very strong. Inventories continue to fall, even with China under lockdown, even with SPR releases. Global inventories are still falling. And so I'm bulled up for Q4 with the admission that we've got some binary kind of issues in the next month and a half that we're just going to have to contend with.
Right. And again, looking forward to the end of the year. Right now, there's so much talk about what's going on in Europe, the energy crisis there. What is the winter going to look like? So far, this talk has really been centered over there. How long before we start seeing talk about energy crisis happening in other parts of the world?
Yeah, it's a good question. Like we're having in North America, you've got California under a heat wave, a state that just said we're going to ban the sale of internal combustion engines by 2035. And at the same time, the very next day, they told citizens, oh, by the way, you can't charge your car between like 4 and 8 p.m. because, you know, our grid's now relying on increasing solar. And by the way, the sun doesn't shine very strongly. It's, you know, 7, 8 o'clock at night. So I was optimistic that the crisis being experienced in Europe would be a teachable moment for energy policymakers, you know, Canada and the United States, et cetera, to allow them not necessarily to publicly admit that they've made mistakes, but at least to use that as a smokescreen to pivot. My optimism is not quite what it was a couple of months ago. I see our government, you know, not backing East Coast LNG when, you know, we started at the same time at the United States. We have yet to export a single molecule. The US is exporting 12 BCF a day. And, you know, I did the math recently. Every BCF is about 400 million on lost royalties and taxes to Canadians. So that's over 4 billion a year. Like that's 10 big hospitals every single year that we could be using. So if politicians as of now don't get it, I'm struggling with, well, what more? Like when power goes up 20 times, does this not tell you that wind and solar, you know, is not reliable enough to base your grid around? We're going there eventually, you know, and whether it's the electorate that is sick of paying high energy prices, and, you know, we're countries blessed with an abundance of natural gas and oil produced in the most ethical and clean manner of anywhere in the world. You know, at some point, politicians will wake up to say, gee, maybe we should harness this and get fully behind it.
Yeah, no, I think that's probably true. I think it will most likely be people who end up driving that change. And speaking of people watching what's going on in the markets, I want to ask you about, if people are seeing this going on, how can they get exposure? So we know that you manage two funds. There's the Ninepoint Energy Fund and the Ninepoint Energy Income Fund. For those who aren't aware, I wondered if you could talk about the difference between them. And perhaps we know there's been a monthly distribution increase recently announced for the Income Fund.
Yeah, so we have two very distinctive funds trying to solve two different problems. One is my main, the Ninepoint Energy Fund, which was the best performing energy fund in the world, both last year and traditional energy fund in 2019. We focus our efforts to try to find the most mispriced opportunities where we can identify a catalyst, acquire a large, meaningful position, and then just wait for people to hopefully see what we think we see. And performance there has been quite good. So that's where people say, I'm not worth what I want to be worth, and I want maximum capital appreciation from someone who's been doing this for 19 years that has done an okay job of steering the ship. But there was always a portion of our client base that said, that's great, Eric, but I also, I'm getting older, I want monthly income. And so we never had a solution up until earlier this year. And so we launched the Ninepoint Energy Income Fund, which was one of the most successful ETF launches in Canadian history on the NEO exchange. And what we do is we're focused mainly in the US. It's about an 80% weight in the US. And it's a dual strategy. And one, we're buying variable paying dividend companies. We're in the US shale, between $80 and $100 oil, we're looking for dividends of between 8 to 10%. So pretty good on their own. But at the same time, we're writing covered calls, and that's really where all the juice is. We're making about 1.8 times the income from writing calls than we are on the dividends. So we've got 5 months under our belt. And on average, we write calls. So we're somebody's buying from us the ability to buy our stocks from us, on average 16% higher 1 month out. So for the worst case, if an income investor can only make 16% in a month, we get called away and we buy it back. That's not terrible. But in exchange for that, we're making so far 16% annualized from selling those calls. And so we're making 16% on the calls. We think about 7% net of all the fees and stuff from the dividends. So it's over a 20% annualized real return, like no return of capital monkey business. So recently we increased the distribution by 40%. When we came out, we said, okay, we're going to pay 5%. We bumped that by 40%, but we think we're doing materially better than that on an annualized basis. And by the end of this year, so we're 3-4 months away, there'll be a true up between what we've generated in income versus what we've paid out. But on an annualized basis, it seems like we're generating well in excess of 10% real cash on cash return. So we knew it was going to be a good strategy, but it's going even better than what we had imagined.
Right. And I like that you've got two options for different types of investors. I think that's always great. If we look at individual stocks, I know we've talked about this before, where you see opportunity among the different types of companies. At one point, you said it was tough because really everything was looking good. We've also talked about the Canadian dividend paying oil producers. So where do you see the most opportunity at the moment?
Yeah, so for somebody that's saying, okay, I'm looking, like I'm always looking for multi-baggers. My original mentor, Eric Sprott, was key on that. You know, you're looking for, you're trying to make 10x your money. And I don't know if that's necessarily available to energy investors now, but we think there's the possibility of stocks going up well in excess of 100%. Because on average, if we're right at $100 oil is a good floor for the next couple of years, our average name right now is trading at about a 33% free cash flow yield. So they could privatize with 3 years of free cash flow. And on average, they're sitting on 17 years of inventory. And they're trading at about 2 times cash flow when they used to trade at 8. So my belief is that if you focus on Canadian mid-cap oily companies that are generating record amounts of free cash flow, we've been, I think, successful in having good conversations with them for 2 years, where you're now at that inflection point where they've paid down their debt enough, and you're going to see more and more of that free cash flow. My ask is 75% of all of the holdings, of which we're the largest shareholder of. Next year, we want 75%. And so you're looking at 25, 26, 27% of returns. So that's dividends and buybacks. And I really want buybacks. So what I'm telling companies is tell the world you're going to privatize. That's the road that we're on until people wake up and recognize that there's a massive disconnect between what we're trading at versus what we're worth. And until that time, buy back every single share you can with your free cash flow. Because we have opportunities like holdings where they have 35 years of production and they're trading at 3 times. Well, that means I'm getting 32 years of free cash flow for free. And in this one company, it's a small cap or mid cap oil sand company. That 33 years of free cash flow at $100 oil amounts to $40 billion. So my question that I pose is, well, what's the value of the last share? It's an $18 share price right now. So you can go from $18 to 40 billion if you're able to buy back every single share at 18 bucks. Now that's a silly example because obviously the share price is going to go up. And that's exactly the point. That's the power the boards have to drive the re-rating. And so that's where I'm focused on right now. I think for the remainder of this year, really 2023, the catalyst is people waking up to, my gosh, the sector's generating an unbelievable, ungodly amount of free cash flow. And oh yeah, now because of efforts from some, we're going to be getting 3/4 of it, 53/4 of it. And that means massive buybacks, dividends, variables, all of these things that will wake people up to the generational opportunity in energy stocks.
Yeah, and as we're finishing up, you're talking about people waking up to what's going on, which I think is true. As definitely as this year has gone on, I think there's more attention. Do you have any final advice you would share or misconceptions about the sector that you would want to dispel?
Oh gosh, that's like a 2-hour
Probably
conversation.
many. Yeah.
Okay, so I'm just gonna go back to the major tenets of my thesis, and that is, yes, we're all gonna be driving electric cars probably one day. Yes, we're decarbonizing slowly because government policy is taking us there. But we will all be using oil for the rest of our lifetimes because people don't think about, like if I look in my office, literally everything here is either made out of hydrocarbons or it needed hydrocarbons to make it. So one of the two. So people don't contemplate that. They think, well, we're driving electric cars, demand for oil goes away. And why is that important? It's because if you think this is a sunset industry, meaning, the end is nigh, these poor oil field workers, what are we going to do? We got to transition them and all these things. It says, well, why would I put value on long dated reserves? Like I referenced a company earlier with 35 years of production. Well, if we're not using oil in 3-4 years because we're all driving EVs, what's the value of those reserves? They're stranded assets. So that's the biggest misconception. Once you wrap your head around I think the fact that we'll be using oil for many, 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 many years, suddenly then there's value on those reserves. And for a company with decades worth of free cash flow from those, that's where the value and that's where the catalyst is. On supply, I still struggle with people that saying, well, geez, Eric, I've been hurt. Basically what they're saying is I've been hurt. I've been hurt too many times. I can't get hurt again. Those bad shale guys, when are they going to go back to their old ways? When are they going to drill again and grow and spoil the party? And I've done as much work as humanly possible and conversations and keeping up to speed. That is in the past. That is not the path that we're on going forward. So those are kind of the two big things: demand and that marginal source of short cycle supply that can come onto the market, theoretically 4 to 6 months. If there's a price signal, all of these things, I think they've learned their lesson. And investors, like in my Ninepoint Energy income fund, like we've got companies paying us 10% dividends. What's the willingness of the owners of the business to allow those guys to take that money away? Like that's not happening. So To me, those are the two biggest things. There's tremendous value on long dated reserves, but because of energy ignorance, the market's not ascribing any value to them. And then secondly, well, what's other than a global depression on the supply side, what's the only potential thing that could ruin the party? Well, it'd be US shale growth. And for many, many reasons, I think that's not a relevant concern. But it's a really good question to ask.
Okay, well, thank you so much. This was great. As always, really appreciate the crash course and what's going on in the oil market.
You bet. Thanks very much.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Eric Nuttall with Ninepoint Partners.